What's up, everyone? In this video, I'm going to talk about what the infinite banking concept is and talk a little about what it's not. Why listen to me? My name is Luke Tatum, and I'm an authorized infinite banking concept practitioner. That means I have been interviewed by the board of the Nelson Nash Institute, I've completed the coursework for the program, and I've taken an exam to prove that I understand the ideas. You might have heard of the infinite banking concept. In casual conversation, it's usually shortened to IBC. So in this video, I'll do that as well. If you haven't heard of IBC, no worries. That's what this video is here for. People who have heard of it are generally in one of two camps. On one hand, you have people who are already doing IBC and they love it. On the other hand, you have people who have done a little bit of research and decided that it's a scam. Why is IBC such a love it or hate it thing? Honestly, I think it's mainly because it can be pretty confusing, and the plethora of misinformed videos out there don't really help. So let's set the record straight. What is IBC? The infinite banking concept is, at its core, the idea that you can recapture the interest that you are paying to outside finance companies, especially banks. Note that I did not say it's a way to create infinite money. It's not a way to get something for nothing. It's not taking advantage of an insurance company, as you'll sometimes see online. And it's certainly not a tax loophole. No, IBC is just one answer to the question of how do you finance the things that you buy in your life? What kinds of things am I talking about here? An appliance, some furniture, a car, maybe a house, an investment, major purchases. Now, it just so happens that the features of a dividend-paying whole life insurance contract, especially one from a mutually owned life insurance company, can help you finance those things in an efficient and beneficial way if you properly understand and implement this idea. So, why is it called the infinite banking concept? IBC got its name from a man named R. Nelson Nash. In the year 2000, Nelson released a book called Becoming Your Own Banker, but he had been doing seminars on this subject for many years before then. Let's break the name into its three pieces. Infinite shows us that there is an unlimited number of ways to apply this idea. Banking illustrates that you are taking control of the financing role in your life. This is what Nelson would call the banking function of your life. And concept stresses that this is an idea. On page 3 of Becoming Your Own Banker, which is really the beginning of the book, Nelson says, "Becoming Your Own Banker, the infinite banking concept, is a text for a 10-hour course of instruction about the power of dividend-paying whole life insurance. It is not a sales tool for life insurance agents. It is education that the life insurance industry should have taught during the last 200 years. Unfortunately, the industry has concentrated on the death benefit qualities of the contract and has neglected to adequately describe the financing capabilities that it presents for the policy owners." So far, you may be thinking that this IBC thing sounds pretty boring. Stick around a little longer and I think you'll feel differently. Let's just take it for a given that you're going to need to make large purchases throughout your life, the things like cars and appliances that we talked about before. For now, I'll just run with the idea of a refrigerator, and let's say this fridge costs $2,000. The question is, since you are going to buy this fridge, how are you going to pay for it? You could put the purchase on a credit card. The store that's selling the fridge is probably very eager for you to choose this option. This means that you get the fridge now, but you haven't actually spent the money yet. You didn't have to save up for it. In exchange, you have a loan and you'll be paying an interest rate of some kind over the life of that loan. It's important to note here that if a store is advertising 0% interest financing, you're not really avoiding paying an interest rate. You're still paying an interest rate. Stores don't give merchandise away for free. It's just a creative way for them to build a certain amount of additional markup into the price, and it makes you feel good because you feel like you're getting a better deal. If you don't want to use a credit card, maybe you should pay cash. Paying cash is great, but here's the kicker. You're still paying an interest rate when you do that. It's true that you're not paying an interest rate to someone, but you are giving up the ability for your $2,000 to earn an interest rate for you in the future. In other words, the money is gone. You got the fridge, you lost the ability to earn money with the $2,000. Now, the IBC way is to save money in a dividend-paying whole life insurance contract. Then you can use what's called a policy loan to finance the purchase. A policy loan is a unique type of loan. When you get a car loan, the collateral on that loan is the car. If you don't make payments, they can seize your car. The collateral on a policy loan is the death benefit on the life insurance policy. There's not really a thing to take. There's also no credit checks on policy loans. At any point during a whole life policy contract, you will have a cash value that's increasing over time, and you can access that cash value via policy loans on a contractually guaranteed basis. No questions asked. As long as you're paying premiums, your value is increasing over time. Now, you should pay back your policy loans, but when you make payments and how much you pay are completely up to you. There's no minimum monthly payment, and the insurance company is never going to call you or send you a letter threatening you if you don't make a payment on the loan. So you want to use a policy loan to buy a fridge. What happens? You request a $2,000 policy loan, and the insurance company either mails a check or deposits that money directly into a bank account that you have. You take the $2,000 and you buy the fridge. As far as the store is concerned, you paid cash. There is a modest interest rate on that loan, and the interest will accrue over time. However, remember that we said this is a dividend-paying whole life insurance contract. If you have a contract with what's known as a mutual insurance company, then you're a part owner of that company. They'll pay you a dividend when they make money. And life insurance companies are pretty good at making money. You get to choose what to do with that dividend, but at our agency, we're going to recommend that you use it to grow the cash value in your policy. So here's the magic of IBC. You can tap into an ever-increasing pool of money to finance the things that you need in life and earn a dividend at the same time. This allows you to sort of do two things at once with your money. You can buy the fridge and you can earn the dividend at the same time. Now, there's a lot of detail to go into with policy loan mechanics and policy design, and everyone's situation is unique. But this is the idea of IBC. It's really all it is. It's not investing in life insurance, as you will sometimes see people say online. It's just using a life insurance policy as a vehicle to manage your cash flow. And yet, some people seem to go out of their way to mischaracterize IBC. If you'd like to see a reaction video that I did to Graham, Stephan, and Dave Ramsey on this subject, you'll find a link to that in the description. It's important to understand that setting up your family with whole life insurance policies is a very long-term decision. You have to look at the big picture, and you have to be willing to look 10, 25, 50, 100 years in the future. The more you lean into this strategy, the more the benefits will accrue to not just you, but to the next generation and to the next generation after that. This is the kind of thing that can really change the financial trajectory of an entire family. But again, this is not a get-rich-quick scheme. There is a net cost to setting up a life insurance contract, and that is true 100% of the time. But as a result of paying that cost now, in a few years, you'll be operating in a better financial environment than virtually everyone. So if you can see why paying cash is superior to using loans or credit cards, then with a little bit of time and study, you can see how using IBC is superior to paying cash. Now, most whole life policies out there have a cash value that's growing over time. If you already have a whole life policy, you might want to check on it and see what's available. But the reason you want to work with someone who is trained to create so-called IBC policies is so you have greater access earlier in the contract. And of course, you'll end up working with someone who has a stake in your success over the long haul. This is someone you can call to discuss different deployments of the capital you're building in your policy. Your agent is also there to help you avoid potential tax issues and to give you advice over the lifetime of this asset. If you'd like to learn more about IBC, be sure to subscribe to the channel. In the description below this video, you'll find a link to our blog, our booking page so you can set up an initial consultation with one of our agents, and a link to my book, Between the Lies. My book goes into a lot of detail on not just IBC, but many of the different pitfalls in the financial world. Thank you so much for watching. I hope this video helped, and we'll see you next time.